Yeah, all right, ladies and gentlemen. Today is another good day the Lord have made. Right. We just have to be grateful. You know, I was telling somebody just now when we were coming, I said, you see, when you look at the air, we don't value what nature has given to us. Right. Imagine if you sick, you hospitalized, then you are in the hospital, of which they have to put oxygen in your body. You know how much it costs? It's a lot of money. A lot of money. So whatever we're getting freely, we think that it doesn't have value. There was a guy, listen to this story. There was a guy, an old man, listen quickly. An old man was admitted in a hospital, was sick, of which they needed to put oxygen in his body because he couldn't breathe. Then they connected some bottles of oxygen, okay, whatever. Then after a few days, 5 days, then they gave the old man the bill for the oxygen they have used. Then the old man started crying. Ask, then they were asking the old man, what is the problem? He said, because you don't have money to pay. You got no enough money to pay. He said, it's not that. He said, I got money to pay. He said, you see now, when you look at how many days did you use this oxygen? Did you give, was he given the oxygen? 5 days. He said, for that 5 days, you charge this heavy amount. So it's a lot of money. Then the old man said, look at me. Do you know how old I am? Almost 90, 80 years. He said, calculate the number, the amount he has to, if he were to pay God, right? For 5 days you are charging this. Calculate the number of days himself have used the oxygen provided by God. And it's free. God never charged him money. Yeah. Did you see? So the irony of that is that you must always be grateful to God. Because this air you are thinking about, you think is just, it's common. It's not common. Right? All right. What we need to discuss today is about the asset. We talk about the asset, the fixed asset and current asset, right? You must, like I said, it's very important for your business to have asset, right? So that you can be able to run your business, right? Then we said we classify fixed asset, long term, short term. Then we got uh, short, long term as those assets that can serve you for a long period of time. For example, like a landed property, right? Can be classified as short and long term. Short term, it doesn't last month. For example, if you have cars, things that you know, it can, before you know, anything can happen, right? You classify those ones as short term. Then cash, right? It's a current asset in the sense that, you know, when we are to talk about the liquidity, the rate at which it can be converted to something else, it has a very high level of liquidity. Then debtors, it's a current asset. When the debtors they pay you your money, then you got cash and stock as well. When you sold your money, your stock, then you are going to raise the cash. So all these ones are convertible, right? You can convert cash to buy stock, right? You can dispose of stock to get cash. And when debtors pay you, You can get receive cash. When you sold your stock on credit, then get debt. So it can be converted, right? So then you need to know about liabilities, right? Very important. In a business, we got what we call long-term liability and current liability. So which liability means debt, right? Owing, right? You owe. For example, when we are talking in terms of long-term liability, we talk about the shareholders, right? The shareholders, they invested money into your business, right? It's not for mahala. They're waiting for returns on their investment, returns on capital employed, ROCE. You need to pay them back. And that money is not yours. They can decide to take back their money if they will, right? Whenever they decide or they decided to take their money. So you are liable. Let's look at this word. Liability. Liable. Right? Yeah, you are liable. You are liable to make sure that you pay them whatever they've invested in your business. For example, if the business is not going well, they can even decide to sell their shares. Right. So whatever investors have put in your money by way of holding shares or whatever, even if it's an angel investors, let me introduce that concept to you. There's what we call angel investors. Those are people that are looking for businesses to put money. Right. I was accessing the business management exam for students. Then they ask those type of questions. Like, for example, where can you, what they were asking questions relating to external source of funding a business, right? We got internal source, we got external source. For example, internal source is you putting in your own money from your savings, right? So if we talk about external source, if your money, your savings cannot, is insufficient to finance your business, you can go outside, right? You can either issue out shares, it depends on the type of company you are operating, if it is a publicly liability company. So if it is a partnership or whatever, you can borrow from friends, from families, right? You can as well look for angel investors. They got some companies. So they're looking for where to invest. They're looking for good company to invest their money, right? All those type of stuff, right? Then, by virtue of the fact that the money doesn't wholly belong to you, you are liable to pay that money back one day, somehow, some way, right? Then you have long-term loan. Long-term loans, for example, if you take a kind of an overdraft or short-term loan from the bank, right? You are liable to pay back. Then current liabilities, right? Okay, not no current. That is current liability. No long-term. This loan, long-term loan, is the loan you took from the bank, right? Like bond. Sorry to say, right? Yeah. This one is not overdraft. I was a bit confusing you now. Long-term loan is a kind of a bond, right? It could be a kind of a bond, it could be a kind of a debenture, right? So that it will take you long time for you to pay it off. Whatever loan you're taking that is beyond 12 months, right? Whereby if the repayment period is 12 months, under 12 months or 12 months is overdraft. If it is beyond 12 months, then it's a long-term loan. For example, when you want to buy a car, right? The financing period these days, most of the cars now is 60 months, right? Or 72. 72 months. 72 months means 6 years, right? So you can take a long-term loan for 6 years to finance a car. If you want to buy a house, the bond, if you want to take up a bond for a house, then you can take a long-term loan. That is for individual. For example, if you want to build an office space for yourself, you're not gonna take overdraft to build it. You take a long-term loan, right? Any loan that is more than 12 months should be classified as a medium to long-term loan. Then current liability overdraft, right? Overdraft is 1 year limit, right? Loan, short-term loan. We call it a short-term loan. For example, you need a bridging finance. You know what we call a bridging finance? Perhaps it get to a certain point that you want to pay your salary or pay the salary of your workers, and the money your debtors are owing you is not yet paid. Now you're short of money. You cannot start telling your workers that there is no money to pay their salary. You can quickly run to the bank and apply for an overdraft, what we call a bridging finance, for you to quickly make up. Right. Then creditors, when you are selling your stock on credit. So no, the creditors, when you are buying things on credit, when you buy things on credit, right? Your stock, for example, if you are doing a retail business, you bought your stock on credit, right? Those are your creditors. One day you need to pay them back, depending on the agreed terms. Guy, do you understand now? The difference between creditor and the debtors. Do you understand the difference between debtor? Remember, debtor was part of an asset, current asset. Then creditor is part of a current liability. It's a liability in the sense that you need to pay your debt. You are liable to pay your creditors. Who are creditors? Creditors are supplier to your business that have given you supplies or product or items for you to sell. Right? And when you sell those things, you must pay back the money. Does it make sense to you? Then tax, you are liable to pay tax as well to the government. Like I said yesterday, unless you are that kind of a person that is unpatriotic, right? If you are patriotic, you know that whatever you get from your business, from your profit, you are liable to pay certain percentage of it to the government, right? So that the government can have money to keep on doing what it's doing. You understand what I mean? Right. So today we are going to talk about break even point, right? It's at a, when we say break even, what are we talking about? It's a point in the business whereby your sales is equals to your expenses. Sales minus expenses will be zero, not at this point, break even point, which means the total cost, Jonga, the total cost, the variable cost. Okay, let's put it this way first. Break even point, sales minus total cost is equal to zero. Sales minus total cost equals zero. It's a point in a business where you neither make profit nor loss. Neither making profit or loss. Right? So your sales, once you remove your total cost from it, it become naught. You know what I mean by naught? Hello, are you focusing? Are you hearing what I'm saying? Yeah. When you remove your total cost from your sales, from your revenue, the balance will be naught, zero. That is what we refer to as a break-even point in the business. So what constitutes the total cost? Total cost is made up of Jonga, fixed cost and the variable cost. This is the line for variable cost. This one, Jonga, this one. Right? This is the one for fixed cost. Irrespective of the sales volume or the volume of production, it remains the same, horizontal. Right? This one is the revenue. When you sell one, you make money. Right? This is the revenue line. Where the revenue line is cutting the total cost, that is where you have the break-even point. graphical solution. They can give you a graph, right? But yeah, at your level, I don't think they're going to ask you to resolve break even with using graphical solution. Because I know this kind of question, you can always find it at the diploma level, right? I don't know. But just understand it, right? This one, this line is the fixed cost, right? The fixed cost, Jonga, the fixed cost plus the variable cost, right? This line is the sales, cutting the total cost here, right? Cutting it here. That is the break-even point. That is why we said sales minus total cost will be not at a break-even point. It's very interesting. I love it. Very nice. Do you understand what we are saying here? We say fixed costs, variable costs, and sales. Does it make sense to you? Now, this is how to calculate a break-even, right? Very easy. You have the selling price per unit, then you remove the cost price. Most often, it's better to use the selling price and the cost price. For example, if they give you a certain amount of, or okay, let me first of all finish with this, right? Before I give you or explain to you another scenario. So you have the selling price, for example, 30 rand, 50 rand, as the case may be, as you've seen it here. Then you remove the cost price. Then whatever left, we call it gross profit per unit. Right. In other words, you can call this one contribution margin. Contribution margin, another word for it. When you are calculating a break even, or when you are trying to establish the break even point in a business at a certain point in time. Right. Now, you will be given fixed cost, which is 2,000. So now, for you to calculate the break even or the break even point in this business, the formula is fixed cost divided by gross profit per unit. This one is going to tell you how many units, right? How many items that the business needs to sell in order for the business to be able to pay off both the fixed cost and the variable cost. In other words, what is the quantity that the business must sell based on the selling price to make sales equals the cost, the total cost, without making profit or making a loss. Do you understand what we are trying to establish now? Right. You've got a business, right? Mutonga, let's look at it this way. You got a business, right? That business, you got two type of costs that you do incur. One is the fixed expenses or the fixed cost, if you will, right? Then the other one is the variable, right? Now you selling, for example, bread, right? Now you've known the price that the cost price of your bread, you know the selling price of your bread, right? Now you are now trying to establish how many bread, what would be the quantity of bread that I can sell, right? To make sure that my sales is equals to my expenses, whereby you will not be owing anybody. Because when you are at a break-even point, it's not so much a bad situation for a business. Because at least, or rather, let me put it this way, to say the least, you've paid off the expenses. You are not owing anybody. Do you understand what I mean? So if you want to know the quantity of bread you must sell, right, for you to be able to pay off your expenses without owing anybody, then you use this formula. You say fixed cost divided by the contribution margin. Then it will tell you, to provide you the quantity of bread you must sell right? For you to be able to pay off your expenses without owing anybody. It's very interesting. In due course, I will walk it back and prove it to you that this thing is correct. Do you understand? Okay, let's look at it now. Let me try to prove it to you that is correct, right? For example, we said, Jonga, look here, he's sleeping. Yay, touch him. He's sleeping. You can do that. Okay, guys, let's go. Look at what I'm saying. Like, listen. Here we said 100 bread must be sold, right? In this business, when 100 breads is being sold, you are able to pay off your fixed cost and your variable cost, then the balance gonna be zero, right? I'm gonna prove it now. That is correct. Okay, let's go. Now we say 100 bread, right? So let's first of all calculate the sales. The sales. So I wanted to use this one to explain something for you. It's the same thing we did here. It's interesting, huh? It's interesting. We said, Jonga, hey, this thing can clean. Okay, let's do it, right? We said when this business is selling 100 bread, the business will be able to pay off the cost without owing anybody. So, in other words, sales minus expenses is gonna be zero, right? This is what we want to prove now, right? Based on the data we got here. We say sales, are you seeing it? Sales minus expenses would be zero. This is the break-even point, right? Of this business. Right. Then it has been calculated that 100 breads or 100 items must be sold. Let's see whether it's correct. So let's first of all calculate sales, right? Sales. How many we say it must be sold? Quick, time is going. I want to finish the work now. How many? 100. What is the selling price? 50 rand. So what do we have here now? 5,000 rand. Right? Okay. This one constitute the income that is coming to the business. We say the income based on 100 item of bread to be sold, based on 100 quantity, the cost must be equals to the sales, the revenue, right? To make it sales minus total cost zero. So now we got the sales, right? Now let's calculate the cost, the total cost. You got two costs here, fixed cost and the variable cost, right? So the variable cost, how many bread we need to sell? 100. What is the selling price? Right? What is the selling price? It's not, no. Okay. What is the cost price? Sorry, I asked you a wrong question. What is the cost price? 30 rand. So this one we have 3,000 rand. Right? What is the fixed cost of fixed expenses? Right? 2,000. 2,000. Right? 5,000. Did you see now? Right? Sales minus the total cost. This is the cost now. Right? Which is 5,000 minus 5,000 equals zero. Did you see the logic? Yes, we said at a break-even point, sales must be equal to the expenses. The expenses, the total expenses. This is the total expenses. which is 5,000. The sales is 5,000. 5,000 minus 5,000 is not. That is what we mean at a break-even point. It's very interesting. It helps you to know the direction of your business. It can help you to make an informed decision as to where your business is going, whether there's a hope or whether your business can be able to survive. Does it make sense to you? Is it confusing? 2,000 is the fixed expenses you're gonna be given. For example, like rent, the person need to pay rent. The person needs to pay insurance. Remember when I was teaching you fixed costs? That means expenses that remains the same. It will not change, irrespective of your sales volume. I gave you an example of rent. Rent doesn't change. Uh, Insurance doesn't change. If you rent a full line, although these days we don't have a line, but we can still have a good example like phone yam. You know that program, phone yam. Yeah, you rent a phone, right? So the amount for rentage is the same. Whether you are making sales, your sales volume is going up and down. You cannot joke with the phone yam. If you don't pay, they're gonna cut your line. They suspend your line. You see, all those expenses that stands and remains the same or stay to remain the same throughout. Those ones are the one we classified under fixed costs. So, and that is what you are using to calculate how many, the quantity of items you need to sell for you to be able to pay off that fixed cost as well as the variable cost. Always, always, fixed cost. Always give and retain. What are you gonna like? You say the expenses, like the way you did it. Yeah. Only like the fixed cost, the variable cost. Always give them. Like as you said. Yeah, they will give you. Yeah. Okay. If you don't want to, there's another way to calculate break-even point in money. Remember what we did now is in quantity, right? How many you going to need to sell? There's another way to calculate it. It will give you the rand. Instead of having 100 rand times 50 to give you 5,000, your answer will be 5,000. So that one, we said there's a formula for it. We say fixed cost over gross profit percentage. Yes. Fixed cost over gross profit percentage. For example, what is the gross profit percentage here? It's going to be 30 over 50 times 100 over 1, right? Which is about 60%. Then you say 2,000 divided by 60%. You work the gross profit percentage. Okay, this is exactly what I did, right? I explained to you just now, right? Gross profit minus fixed cost, that's exactly when you are using 100 units, right? What about the break-even in value? We call it the break-even in value, right? So here now, you need to work out the gross profit percentage. Then you say fixed cost divided by gross profit percentage. Okay, let me try to explain to you the differences, right? For you to know. If you want to know the quantity that you need to sell, right? For you to be able to be at a break even, right? You say fixed cost divided by gross profit, just gross profit. How do you get gross profit? Selling price minus cost price. Does it make sense to you? Whatever you are going to have, it will be the unit, the quantity that you need to sell, right? So once you've established the quantity, for you to know the amount, you multiply by the selling price. You see, so it's a bit a long process, right? Now, sometimes they will ask you to calculate the break even in value, not in quantity. That means, for example, the one I did was in quantity. For you to be able to establish the break even in value, which is rand value, you multiply the quantity by the selling price. Remember, that is what I did. Taken. You've seen what I did, right? Okay. Now, if you don't want to go that route, when you are asked to calculate the break even in value, in money now, not in quantity. So you are going to use a different formula. Of course, the fixed cost is still there. Instead of you to say fixed cost divided by the gross profit, now you use fixed cost divided by gross profit percentage. In other words, you need to calculate now first the gross profit percentage. So what is the gross profit percentage? How do you calculate it? It's easy. The gross profit, remember what I said? Gross profit expressed in a percentage of sale, or let me put it, refine it more better. Gross profit expressed as a percentage of sales, which means gross profit divided by sales times 100 over 1. For example, now we are using the selling price and the cost price, which means the gross profit divided by selling price times 100 over 1. Does it make sense to you? Okay. Now, let me explain to you again one important thing, something that is crucial here. We must know the difference between sales and the selling price. Selling price is for one item, right? Sales is an agreement, multiplication of the units sold times the selling price. Did you get it? When we say sales. So if you are given the value for sales and you are not given the selling price or the cost price, right? So what you do is you take the total number that is sold, the quantity, you divide by the value of sales. Then you get the unit price. Does it make sense to you? Do you get it? What I've just said now. How do you get a selling price? You divide the sale by the number of units that were sold. Then you know the price for one. Does it make sense? Are you catching it? Right. Now, when we need to calculate the gross profit percentage, right? You just say 20 because that is the gross profit. Divide by the selling price times 100 over 1. Then you have 40%. Then the break even now will be 20% divided by 40%. Then you have 5,000. Right. So you see that the break even now is 5,000. That means you need to sell now to the tune of 5,000 rand for you to be able to pay off your costs, your fixed costs and variable costs without owing anybody. Right. Okay. So they work it back here now, right? Says 100 unit and 50 rand per unit. Then you got 5,000. Then the gross profit, which is 40%, right? That's right. Then if fixed costs are 2,000, you see now, the fixed costs here now, they are the same. You see? So that is what. Now, when you remove it, you minus it is going to be zero from the sales. Right. That is what we are saying here. Let me see. The one-stop startup cost of a business. Okay, guys, listen. This one is very interesting. Look here. For you to be able to distinguish between fixed asset and pre-operating cost. Pre-operating, what is means is before you start operating the business, certain expenses that you need to incur, the cost of those expenses That is what we refer to as pre-operating costs. So here you can be able to give know some of the examples of a fixed asset, land and building, right? Like we said, machineries, right? To do the job, vehicles, as you may pronounce it, furniture, tools, cash register, sales, computer. These ones are your asset, resources that you are need to run your business. Before you start your business, telephone, answering machine, vacuum cleaner, counter, kitchen equipment, and cell phone, right? So you need to know. Guys, I know the period is over now. This aspect, yeah, let me put it this way. This aspect is very important. Cash flow. I'm not gonna rush it. Now I'm gonna take a whole day or two, 1 day or two to explain this. This cash flow is very important, right? So how many slides we got here now? Still a lot, but never mind. So we are going to start learning this aspect, how to calculate cash flow, the cash flow statement, how you can be able to read and understand it, and then know how to work out the calculation. Right? As you said, as a form of introduction, as a kind of introduction, cash flow is the movement of money in and out of the business. So if you are a business owner, if you know how to work out your cash flow, you know how to control it, it will help you to prevent you from being a cash strapped, cash shortages. So then we said the percentage of save for cash and those on credit. Okay, the cash, listen, very important thing I want to explain here. You see, when we are talking about cash flow is about cash you receive, money that you receive, cash, not something you sold on credit that you record when you are doing your cash flow. Right? There's a little bit there's an area that is a little bit tricky. If you are running your business whereby you are selling cash and credit, right? The one you're gonna record is the one you remember. Look at the statement. They say cash flow, not the one you sold on credit. Let's say you got a business, you are selling both credit and cash, right? The one that you receive on cash is the one the amount that you are going to write down. So you leave the other one. By the time the one you sold on credit, you receive the money. The time that you receive the money, that will be the time you will record it on your cash flow. Because we are looking at the movement of money. We are not dealing with credit. Do you understand what I mean? So it's very interesting. Prepare for it by the grace of God. Tomorrow you're gonna enjoy it. Right? Okay, let's stop here.